This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, having learnt the basis of allocating transactions to a given return period, usually a quarterly VAT return period, as we said, and as we will see in section 5 of this chapter. What we've now got to look at is the respective sides of VAT. The output VAT, as we know it in relation to the taxable supplies, the sales that we make, and then the recoverability of input VAT for the same VAT return period in relation to our costs, our purchases and our expenses incurred. Because it's that matchup of output VAT less the input VAT for a given VAT return period that will determine, as we've said before, either how much, as it usually is, the business, the trader, owes to HMRC, or very occasionally, because input VAT exceeds output VAT, the amount of VAT that can be reclaimed from HMRC, we, the trader, get a payment back from HMRC. The usual situation for that, as we know, is where we, the business, the trader, we make zero-rated supplies. Those are taxable supplies, so we can indeed register for VAT, but the inputs that we incur are standard-rated inputs. So we've incurred input VAT, but there is no charge for the output tax because it's at a zero rate, but therefore we get to reclaim that input VAT, that excess of the input VAT over the output VAT. But in relation to looking at those sales and those costs and expenses, there's a few issues that we need to deal with in just slightly more detail. So let's have a look at now at section 3, dealing with, as we said, output VAT and input VAT. As the note says, our major points here, several important exam points that if you are asked to establish the amount of VAT either payable, more likely payable than repayable, for a VAT return period, the sort of issues that are going to come up in terms of dealing with the sales and therefore establishing output VAT and dealing with your costs, expenses, and therefore establishing the input VAT. Firstly, in relation to the sales, the VAT is chargeable on the actual amount received. Well, you might say, well, what do you mean actual amount received? That's what we invoice for. Well, we may indeed invoice for a sale of £100 plus VAT at 20% and issue the sales invoice for a grand VAT-inclusive total of £120. However, it's not necessarily the full 120 that will be received by us. We might, for example, in times of cash flow problems, aren't they always cash flow problems, we might offer to our customers a prompt payment discount, saying, look, if you pay us within 10 days, then you can take 5% off this invoice. So in that case, the amount received is not the figure that was originally first invoiced. So the important point here, it's on the actual amount received. This is going to be an issue where, as we've said, a discount is offered for prompt payment. If we've simply got a trade discount that is offered to a certain type of customer, that is already accounted for within the price that we invoice that customer for. We're talking here about prompt payment discounts. If the discount is not taken, the VAT is charged on the full selling price, and if the discount is taken, then the VAT is based on the discounted price. So I issue a sales invoice for £100 plus VAT. VAT on that 100 is of course £20. We have a VAT inclusive invoice price of £120. We offer the prompt payment discount, pay within 10 days. The customer doesn't pay within 10 days, is not entitled to that, so the amount of VAT, of output tax to be charged, is the full £20. But if our prompt payment discount that we've offered is, say, 5%, and the customer does pay within the requisite 10 days, or whatever it might be, then it's not going to be £100, it's going to be £100 less 5% is £95, and the VAT will be charged upon that. And 20% of £95 is going to be, well, £1 less, it's going to be £19. So what happens there, therefore, the amount of output VAT that we record is £19. It's on the discounted figure. So it's always on the amount that is received by us. If we offer a prompt payment discount and the customer takes that prompt payment discount, the amount received is the discounted figure. The VAT, therefore, in my example, 20% of the 95% of the sale, £95. 20% of 95 is £19 of output VAT that must go to your VAT return that we must account for within that return. If the customer does not take advantage of that prompt payment discount, preferring to keep the money in their bank account for a few weeks or months longer than what would otherwise be the case, then it's £100 plus VAT of £20. The output VAT is 20. Now, you might foresee there, it's not going to be an issue for you, but you might foresee a practical issue. That is, well, hang on a minute, if you've issued an invoice for £100 plus 20% VAT, but the customer then takes advantage of that prompt payment discount and he's paying £95 plus VAT of £19, what's going to happen with that VAT figure? Well, all that happens there usually is there's different ways of dealing with it, but the usual thing would be that we just issue a credit note for the £5 discount plus the £1 VAT. So we issue a credit note. You're not going to have that problem, because what you're going to have to do, as we'll see in example 4 in just a few minutes' time, is to establish the amount of VAT payable by computing what is the output VAT to be charged, what is the input VAT that is recoverable. And in relation to your output VAT, on the sales where no prompt payment discount has been taken, we simply take the full invoice price and take our 20% thereof. Again, if it's a VAT inclusive figure that we're given, it's 21/20. If it's VAT exclusive, then we're talking in terms of 20%. If we're talking in terms of this amount of sales, you may have to compute, of course, the amount of sales where prompt payment discounts have been taken, what is the cash amount received, and we take our, again, if it is, and it usually is a VAT exclusive figure there, we simply take the 20% of that amount received. Second point, now looking at the situation, of course, where the very opposite to a customer taking a prompt payment discount, they don't pay at all. So what happens is relief for irrecoverable, i.e. impaired debts. What happens when we have to write a debt off? Now, we're talking here about a real problem so far as the taxpayer is concerned. Quite obviously, you've made a sale and sadly the customer in question has gone out of business or done a runner, whatever it might be, but they've disappeared, they're not able to pay, and therefore we have to write the debt off. Now, it's bad enough that, let's say, we made a sale for £1,000 plus VAT of £200. We issued the sales invoice for the VAT inclusive figure of £1,200. And we waited. And we waited. And sadly, that money never came in. And what we've had to do, therefore, is to write that debt off within the accounts. So what do we do about the VAT? Because when we issued that invoice, it usually is, as you know from the previous lecture, the invoice date is usually the tax point. Based on that, we had to pay over to HMRC an extra £200 of VAT in relation to that individual sale, which would have been fine if the customer had paid us £1,200. We were more than happy to take our £1,000 sale price and keep that money for ourselves and then pay over the £200 of VAT to HMRC. But nothing came in. So what has happened here, to add insult to injury of a bad debt, is we have incurred expenses and purchase costs for materials, for goods, if we're a wholesaler. We've had to buy in, we've had to incur expenses, we've incurred the cost of buying those goods in, buying those materials, incurring those expenses, paying those wages, all to produce a good that is then sold. And we think, at last, We've incurred all those costs. Now we've made the sale, £1,000 for us, plus £200 of VAT for HMRC. That's great. Money in, we keep the 1,000, pay over 200. But what has now happened is nothing has come in. So the only reward we've got from incurring all those costs and expenses and eventually making the sale, the only reward from the sale we get is we get to pay out another £200. We've got to pay out that output VAT. So there has to be some point at which we can get that VAT back. We made the sale, yes. We recorded in relation to the tax point, no doubt the invoice date, and in that VAT return period, in respect of it, we paid out the VAT, including that £200. But we've never received that money. So there comes a point at which that impaired, that irrecoverable debt, we can get back the £200 output VAT thereon. The only question is, when can we do that? And sadly, we have to wait a little while here. The rule says we can only get that relief, only available if the output VAT has been accounted for. So we've made the sale, it's gone on a VAT return, we've accounted for that. And accounted for and paid, so we've paid over the output VAT, of course, to HMRC. And here's the critical one. The debt is over 6 months old as measured from the time that the payment was due. The relief is claimed as input VAT on the VAT return. Now then, as measured from the time that the payment was due. A question may tell you that this particular debt, based on this invoice dated whatever, was written off on such and such a date, and we have to establish then whether or not we're able to get the VAT back from the sale that was made. Well, we don't look at the invoice date, we look at when the amount was due. So we look from the time that payment was due. Now, once we hit 6 months after that, if that date is before or during this VAT return period, then for this VAT return period, we are now able to get that back. How do we get it back? It was shown as output VAT when the original sale was made, so we now claim it back as input VAT on this period's VAT return. So in an exam question, what you get is that we've written off, as you'll see in example 4, we've written off, say, 2 amounts of debt there. You're told when the payment was due to be received, and you then know your VAT return period ends on this date. Well, look at the date that the payment was due to be received, add 6 months. Is that before the end of this VAT return period? Is it before the end of this VAT return period? If it is, then fine, it can go through as input VAT on this VAT return. If we're not yet up to that 6 months, we're going to have to wait until the next VAT return period, when we will have hit that 6-month anniversary of when the amount was due to be paid, and that is when we are able to get the money back. So a problem of your normal accounting for VAT is in relation to sales made, that we, having made that sale, if we suffer a bad debt problem, our cash position is made even worse by originally having to pay out the output VAT on the sale, but never getting that money in. And we're going to have to wait at least 6 months from when the money was due to be received until that 6-month anniversary falls within a VAT return period. And for that VAT return period, then we can get our money back. How? By showing it as input VAT on that return, thus reducing the amount of VAT to be paid over to HMRC for this period. Again, we'll see that with an example 4, in just a few minutes' time. A couple of other points. Again, now looking at input VAT, cannot be recovered in respect of business entertainment of UK customers or on motor cars unless they are used 100% for business purposes. Now, we know on all of our normal business costs, the purchases that we make, the expenses that we incur, normal business costs, any input VAT that we've suffered on those costs should be able to be recovered. But there's just a few exceptions to that particular rule. So the first one here cannot be recovered in respect of business entertainment of UK customers. So any entertainment of UK customers, no input VAT recovery. If they are overseas customers, then we are allowed to get the input VAT back. Now, don't go confusing what we're doing here for VAT purposes with what we did for bad debts in terms of adjustment of trading profit there. It's got nothing to do with that. What this is purely a VAT rule. If we've incurred an expense, we've been invoiced inclusive of VAT for business entertainment. If that business entertainment was of UK customers, we cannot reclaim the input VAT. If it's of overseas customers, we can reclaim the input VAT. The other form of entertainment you may see is where you entertain own staff. And if it's own staff, then just as with overseas customers, that is fine. That is recoverable. The one that we cannot recover, as it says there, any business entertainment of UK customers. Overseas customers, okay. Own staff, okay. On motor cars, well, we may buy a whole load of company cars, of course, unless they are used 100% for business purposes. Now, it is incredibly unlikely that we're going to have cars bought by the business that are 100% for business purposes. The only possibility there is probably something that we classed before, back in Chapter 5, when looking at capital allowances, as a pool car, where it's only available for business use by various or any employees. If it's 100% business use, you can get the VAT back. But usually the cars that we purchase through a business are for the use of employees. And as you know, although it may seem that they only use that for business, going from home to work and work to home, that's private. That is not business use. And therefore, it's incredibly unlikely that you're ever going to be able to get back any input VAT in relation to cars. Input VAT also can't be recovered in relation to the private use by a proprietor of a business. A proprietor, we're talking about an unincorporated trade. So this is only when dealing with proprietors, sole trader, partner in a partnership, i.e. an unincorporated trader. And if we've got input VAT that relates to private use by a proprietor, then clearly we cannot recover that input VAT because it hasn't then been a part of the provision of a taxable supply. There's no output VAT charged at the end of that. So if you as the proprietor have taken goods from stock, you've helped yourself there. Again, notwithstanding what happens in adjustment of profits, here that means that in relation to those goods, the original input VAT on the purchase of those goods, that is not recoverable. If some expense, some service that is in fact private use, again, anything that is private use by the proprietor, sole trader or partner in a partnership, that is going to be disallowed. So with that in mind, the type of problem that we get in relation to a VAT return period is to calculate the VAT payable for a particular VAT return period. These are normally quarter ends. This one, the quarter ended the 31st of March 2021 there. Also note this bottom point, unless stated otherwise, all of the above figures are exclusive of VAT. Yeah, you need to know the numbers in relation to sales, in relation to purchases and expenses. Is that VAT exclusive, so the VAT is 20% on that figure, or is it VAT inclusive, in which case it's 21/20ths of that figure. 21/20ths of that figure if it is VAT inclusive. don't go making mistakes there. Right, we've been told here they're all exclusive of VAT unless stated otherwise. Rose Limited, registered for VAT. All its sales are standard rated. The following information relates to the company's VAT return for the quarter ended 31st of March 2021. Standard rated sales amounted to £120,000. Remember, this is exclusive of VAT unless you're told to the contrary. Rose Limited offers its customers, here we go, here's the issue, a 5% discount for prompt payment, and half of the customers took advantage of this discount. So, we have sales in total of 120. Half of the customers took advantage of the discount, half didn't. So, for 60,000 there, half of the sales, the customers did not take advantage of the discount. So on the full 60,000 VAT exclusive sales price, there's going to be a 20% VAT charge. On the other half, the other 60,000, then we offered a discount of 5%, so only 95% of that was received, and on the received amount, we then take the VAT at 20%. So you'll work out, therefore, what is the output VAT on that basis. So there's one issue, the one issue that we discussed in those notes above, where you have to break down your sales to be able to establish the amount of output VAT thereon. It's not just standard rated sales of 120,000 exclusive of VAT, take 20% of 120,000. We've had to divide it half and half, take 20% on half and 20% on 95% of the other half to work out the output VAT. What they could have done instead is to say half the sales are standard rated and half the sales are 0 rated, in which case, therefore, we'd only have VAT on 60,000 at 20%. Okay, those are the sort of issues in relation to what would otherwise be a very simple figure. Just take 20% of your net sales figure. It makes life a little bit more interesting there for the examiner. Second one, standard rated purchases and expenses, so their standard rated inputs, amounted to £35,640. This includes £480 for entertaining who? UK customers. Therefore, we cannot recover input VAT on entertainment of UK customers. So you'll take your 35,640 minus your 480, and again, because it's a VAT exclusive figure, take 20% thereof, and that will be the recoverable input VAT. Next point, we have got, not sure there why those are numbers 4 through to 8, by the way. A strange numbering system. That should go 1, 2, 3, 4, I would have thought there. How very peculiar. Not to worry. On the 15th of March 2021 there, the company wrote off the irrecoverable debts of £2,840 respectively. On the 15th of March 21, remember, the VAT return period there is 31st of March. Now, to have any chance of recovering that amount of output VAT that we charged, but we didn't actually get to receive the money, then we have to have written it off within the accounts. So relief for irrecoverable debts, only available if the output VAT has been accounted for and paid. The debt is over 6 months. The relief is came and measured from the date of the time. So we have to have written it off and then satisfy, and here's the main point being tested, the 6-month rule. Right, these two debts, £2,000 on one invoice. Again, let's just make sure, yes, we've said exclusive of VAT unless it says otherwise. It doesn't, so these are exclusive figures. So we have 20% on that and 20% on that. Invoices due for payment. Now that's the critical date when were they due for payment? Okay, on the 10th of May and the 5th of December 2020. Well, 6 months on from the 10th of May would still have been a date back in 2020. Presumably therefore, that would have been what the 10th of May, the 10th of November there. What is important is, as we have got a VAT return period to the 31st of March, is it before the 31st of March 21, the end of that VAT return period? Is 6 months on from that due date within or before that deadline date there? Yes, it is. So on the £2,000 at 20%, so what, £400, that amount of output VAT can now be claimed back. How do we claim it back? Look at the note. We show it as input VAT on this particular VAT return. The other £840, now that was due for payment. The payment was due on the 5th of December 2020, or 6 months on from the 5th of December is going to take us to the 5th of June of 21. This VAT return period goes, as we know, to 31st of March 21. So no, it's not 6 months old by the time we get to the end of this VAT return period. So it means that that 6 month date will be in the next VAT return period, the one through to the 30th of June 2021, and only then can we get back the output VAT in relation to that earlier sale back in December 2020. So that one awaits. So only the 20% of that 2,000, the £400 on that, can be shown and recovered as input VAT in relation to the original output VAT that we have, of course, by now paid over to HMRC. On the 31st of March 21, the company purchased a motor car at a cost of £16,450 for the use of a salesperson. Now, that's not 100% business use. It therefore means that there'll be no recovery of any input VAT in relation to that. And we bought machinery at a cost of £21,150. Both of these figures are inclusive of VAT. Well, the only figure we are interested in is that one, the purchase cost of the machinery. The motor cars, just to confirm it, is used for both business and private mileage there. Again, that's making it absolutely explicit, let alone simply implicit there. It's not 100% business use, nor will it be in terms of any question that you do. £21,150 on machinery, it's inclusive of VAT. Therefore, what do you take? Not 20%, 21/20, or 1/6 to its lowest common denominator. Right, that should allow you, therefore, to now put an answer together for that in relation to output VAT on the sales and then the input VAT that can now be recovered in this particular VAT return period. So pause now, do those calculations, and then please check through with the answer in the back. Hopefully, therefore, given the discussion we've just had about that question, there were no problems for you in agreeing with the answer, as you see here. The sales, as we know, we had to split between the ones where the discount, prompt payment discount, was not taken. So that was just the 60,000 at 20%. And then we had, of course, the other half of the sales where the 5% discount was taken and we charged the VAT on the amount, therefore, that was received. In relation to our input VAT, the purchases and expenses total $35,640, but that included the entertainment expense in relation to UK customers. That is not recoverable, so we exclude that and then take the VAT on that net sum. Just one of the irrecoverable debts has its 6-month anniversary of when the amount was due to have been received before the end of this VAT return period. And on that basis, therefore, we can get back that £400 there. The later one, I think it was in December 2020, that will fall into the next VAT return period, the one that ends the 30th of June 21. But we can't have that money back yet. How do we show it? We show it as input VAT to go against, therefore, the original output VAT that would have been charged. The machinery, we do get to recover on that, not the car. That is a VAT inclusive figure, and therefore we take 21/20. Compare the output VAT with the input VAT, and the excess of the output VAT over the input VAT, that is the amount of VAT that is payable, and that would appear to be £12,463 there. Due date, well, actually you don't know that yet. We haven't yet looked at the VAT returns and the admin as regards the submission of VAT returns, not only when they have to be made, but when the payment has to be made. The due date, you'll see here, this is for the quarter ended 31st of March 21, is actually the 7th of May 21. That might seem like an odd date there, but it's basically the 7th day of the second month following the end of the return period. So the return period ended March, April, May, 7th of May, that is the due date. And as we'll see in section 5, the due date both in relation to the submission of the VAT return and also the payment of that VAT. Back to the notes now, and one further issue in relation again to establishing the correct amount of VAT payable in relation to a VAT return period when we look at the output VAT and the input VAT figures to go to that VAT return. One problem area, but it actually isn't a problem so far as we're concerned in the exam. It's very easy because the number you need to use has to be directly given to you. So it's not difficult once you have learnt the rule. But in relation to motor expenses, we're always going to have this issue that we're never going to find in reality a situation where all of the motor expenses that we've incurred, mostly fuel costs would be the main one there, no doubt, but they've all been in relation to business use. We've got a private business mix. So clearly there's an issue, therefore, that in relation to some of the input tax that we've incurred when each of the employees have gone in and bought using the company card there, the business card, bought that fuel, what's happened in relation to it, in relation to the recovery of input VAT? Will we be able to get all of that back? Or are we, in a large company, have to going to get every employee to record every figure of private mile and business mile for each VAT return period? That would be a nightmare. Not only would it be unreliable in terms of what you got back from employees, but it's a huge admin exercise. So in terms of establishing how much of that input VAT would be recoverable, we're going to have a very simple rule, as we will see. Input VAT can be recovered where fuel is used for private mileage, and that's either by a sole trader in the unincorporated trade or an employee of either unincorporated or incorporated trade. But output VAT must be accounted for. So initially, we don't bother with, so what's the private proportion, what's the business proportion? We don't bother with that. We just say, right, all of the input VAT in terms of all those fuel costs incurred by the business in relation to those employees, all of that is recoverable. It's not a problem. But then, because we know that, hang on a minute, not all of that mileage is going to be actually business, some of it is private, but we've allowed all of the input VAT to be recovered. So how do HMRC balance the books here to say, well, you can't have all of that? Rather than reducing the amount of input VAT that can be recovered, all we do instead is to charge output VAT. That is calculated according to a scale charge based on the car's CO2 emissions. you don't have to worry about that, because within any question, the scale charge, which is VAT inclusive, will be given to you in the examination. So you pick that figure up and you charge the VAT as output tax thereon. So let's say, for the sake of argument, that for this particular return period, we have got a figure of £1,200 there of scale charge in relation to the vehicle in question. £1,200, it's rather high, but if it's £1,200, then that is VAT inclusive. So we take 20/1/20ths, but 1,200 1/20ths makes it rather easier, doesn't it, there? So we'll have a figure of £200 of VAT. And what do we do with it? It's charged as output VAT. So as well as having the output VAT on sales, we'd have £200 of output VAT to put through the VAT return period in relation to the motor expenses incurred. You will be told what the scale charge will be in relation to this particular vehicle. I can't imagine that they're going to give you more than one vehicle, but they'd have to give you the scale charge for each. You take 20/1/20ths of that number, and on that basis record it then as output VAT on your VAT return. Provided there is some business use, which is always going to be there'll always be some business use, input VAT can actually be fully recovered in respect of the repairs, the maintenance of a car. So the only time we're going to restrict the amount of input VAT in relation to a motor expense is in relation to fuel. How do we do it? By reference to the scale charges provided by HMRC. The figure will be given in your question. You take 21/20ths of that and show it as output VAT. Job done. Well, job not quite done here, because here you've got example 5, and you've got to state the VAT treatment of the cost of petrol and repairs for the quarter to 31st of March 21 in relation to Poppy PLC. In which case, therefore, pause at this point and answer said question, please. Well, I hope there weren't any problems there for you. Input VAT, of course, can be reclaimed in respect of both the cost of the petrol and the repairs. In relation to the repairs, because there is some business use going on here, all of that input VAT is recoverable. In relation to the input VAT the fuel costs that have been incurred, we still allow all of that, but because there is some private mileage as well as some business mileage, the trader is required to account for the output VAT in relation to the scale charge for that particular vehicle. Again, something will be linked to CO2 emissions, but you'll be given the figure. Because fuel is being provided for the private use of the director, Poppy PLC will have to account for output VAT based on the scale charge. That figure was given as it must be. It is VAT inclusive. Just do your 21/20ths and get the figure, and that is it, job done therefore. Back to our notes for one moment. This session has now come to an end. You'll be again very happy to hear. And where we go next is something we've discussed and we know about, in essence, and that is VAT returns. All I need you to do between now and next time is consolidate, of course, on what we have done so far, and just have a little read through. No need for you to do the illustration there, but just familiarise yourself with this. Again, VAT, it's a bit like law. It's just rule after rule after rule after rule. And there's only one person can learn it, and that's you, for yourself there. I can't do that for you. So you'll need to have a little look through that, and then we'll deal with that illustration 3 together in our next class together there. But have a little read through after, of course, you have properly reviewed the exercises that we've done and the rules that we've seen in this session.